Hello and welcome to the first of 8 new tax year resolutions that I'm going to share with you. None of these will surprise or shock you. Hopefully, some of them will remind you to take action, to engage with your clients, to talk to them about starting the tax year off well. Tax year resolution 1, new tax year resolution 1, income tax planning. Here are the things to consider, because with income tax planning around the tax year, it is absolutely essential to not leave it until the last moment. This is why this is such a great time to think about income tax planning. What do I mean by that? Simple stuff. Make sure that you have sufficient income generation to use the admittedly frozen allowances and lower tax bands. Really important to use them up. If you don't use them, you can't carry them forward. Avoid personal allowance loss. You'll know that if income is greater than £100,000, then you start to have your personal allowance cut back by £1 for every £2 that the income exceeds the £100,000 threshold. There are things you can do to make sure that your assessable income for this purpose does not exceed £100,000 by making contributions to pension arrangements, for example. Transferring sources of income between couples. This is so important to do at the beginning of the tax year to make sure you maximize the incredible power that you can get from this sharing income, where you have control over the income. And of course, one of those situations where you have control will be where you own investments that you can transfer at the beginning of the year to your spouse or partner. Bear in mind that you don't transfer to a spouse or a married or a civil partner, then you will have to possibly think about capital gains tax, depending on the asset that you're transferring. But generally speaking, transferring assets to a person who you're living with, who you're in a partnership with, who you're married to, will, if that person has lower income tax rates or an available lower tax band to use, or available personal allowances to use, then that will make absolute sense if you treat your income collectively, essentially. That's also the case, of course, if you own your own business and you can arrange for income to be paid to a spouse or partner for work that they do, or if you transfer shares to them, and then they can receive the dividends from those shares, provided the shares are fully participating shares, of course. And the last thing to do, of course, is maximize tax efficient income. Use your dividend allowance, use your personal savings allowance, do all you can to do it. Those allowances can't be carried forward. Use them or lose them. And all of these actions, and there are more, should be taken or at least thought about now. Think about them, see if they could work for you, and then take action. Because if you leave this to year-end tax planning, it will be too late to use the allowances, because you won't be able to generate enough income 2 or 3 days before the end of the tax year to use the allowances up. Unless you run your own business, you can pay a last-minute dividend. So the point here is the point of this resolution is think early about the basics of income tax planning.